Hey, what's going on, guys? It's Robert Metrock here with Client Direct, back here once again, just trying to give you a little breakdown of exactly how this SOFR arm works. So the 6-month SOFR arm is a very unique situation. I've already explained it in my previous video. Hopefully you've seen it. If not, you might want to check it out. It might get you a little bit excited. Now, the program works just like every other arm. So it's based off a margin and it's based off an index. You add the two together, you have your fully indexed rate. Very basic information. The margin for a full doc style structure is at 2.75%. Your margin for a non-QM or bank statement or DSCR type loan is at 3.5%. You add your index, you get your fully indexed rate. So that's your very, very basic math for you. There's a lot of ways you could structure it. You could buy down rates, you could do a lot of things to have a lower start, things like that, but that's going to be your very, very brief synopsis of how the margin and index works. Now, the index is tied to the secured overnight financing rate. That is the key. This program's only here because the secured overnight financing rate, SOFR, took over for the LIBOR index. LIBOR has a bad rap. A lot of people are afraid of it. It's really kind of steered people away from ARMs. Entered the SOFR to try to help build back up trust in this unique 6-month ARM program to do it quickly so people start to get into ARM programs again. That's generally the reason why it is here. Now, this program is supposed to be a lot more secure. It's called a 2-1-5 ARM. Now, what that means is very specific to your caps that are allowed in the program. It is amortized over 30 years. It's a 30-year loan. It is fixed for 6-month intervals. So for your first 6 months, you are fixed. It will have an adjustment, and then it will be fixed for another 6 months. It will have an adjustment, fixed for another 6 months, adjustment, so on. Does it every 6 months. Now, the cap numbers 215 refer to your very first maximum allowable adjustment is 2%, hence the 2. Now, I have never seen that done yet on the program. Most recent adjustments were about 0.5%, but that's neither here nor there. The worst case scenario for a client is 2%. The subsequent increases or subsequent adjustments from there are allowed to be a maximum of 1%. That's the 1. Now, aside from that, the 5 is your maximum allowable adjustment period. The entire life of the loan, 30 years, can never increase more than 5% from where you start. That's an incredible, powerful tool. What makes it even more powerful is there's no prepayment penalty. So they don't lock you in. This is built to be a program that helps you feel comfortable, save money, and you have an escape hatch at all times to get out. No prepayment penalty. Take advantage of 6 months of low interest and then figure out the next step from there when you realize what's happening in this market. This program is the most unique and attractive option out there on the market today in 2022, and we are here to present it to you at Client Direct Mortgage. Let's take advantage.